Okay, you guys, we're going to take a look at this same set of information a third way. This would be if the lessor was drawing up the lease to be a sales type lease, meaning they're earning revenue two ways: by marking up the equipment that they're leasing or essentially selling, and by earning interest revenue over the life of the lease. Okay, not to be monotonous, but let's read this again. On June 30th, 2016, Georgia Atlantic Incorporated leased a warehouse facility from Builders Incorporated. The lease agreement calls for Georgia Atlantic to make semi-annual lease payments of $562,907 over a 3-year lease term, payable semi-annually each June and December 31st, with the first payment due at the beginning of the first interest payment period on June 30th, 2016. And remember, as we've looked at before, that's going to make this one present value of an annuity due. That's the table we'll go to. Okay, and here our interest rate is equal to 10% for a year, so 5% every 6 months. And our interest payment periods, well, it's 2 per year for 3 years, so 6 interest payment periods. So our present value, number one, they ask us again, this is the third time we've done this, but determine the price at which Builders is actually selling the warehouse, which would be the present value of the lease payments at June 30th, 2016, again to the nearest hundred. Remember, you can probably quote it by now, but present value of the lease payments. I like doing this same problem 3 different ways, though, you guys, because it gives you it's a capital lease from the perspective of the lessor, or the lessee first, and then the lessor, if the lessor is treating it as a direct financing arrangement, or from the viewpoint of the lessor, if the lessor is treating it as a sales arrangement. Okay, the present value of the payments would be equal to the amount of the payments, $562,907, times a factor from our table, present value of an annuity due. Again, you should know this by now, but that's in the very back page of your book. We're going to come down in the left-hand column to 6 periods, and across to 5%, we get 5.32948. Which I'm sure some of you have probably memorized that by now. You know this is going to come up $2 off, right? But we're going to go with the $3 million in our first entry. Again, I think it's easier to make entries to answer these income statement and balance sheet questions. So, let's see, here we're dealing with Builders. They're going to debit lease receivable for $3 million. And they're going to credit sales, or your book likes to use sales revenue. It is a revenue account, of course. Okay, and then they would have to also make an entry to record cost of goods sold. And they tell you in the last sentence there, I don't know that we've read it that far, but they said Builders constructed the warehouse at a cost of $2.5 million, so that's $2,500,000 was their cost. And then we'll credit. The book says inventory of equipment. I guess that's what we've used before. I'm just going to go inventory here. A warehouse to me doesn't really seem like equipment. Anyway, it's their finished goods inventory, if you will. Okay. So that takes care of the sales portion. Okay, they also received on June 30th a payment from Georgia Atlantic. So they'll debit cash for the $562,907, and they'll credit lease receivable. No interest again was earned because no time had passed off. And then the next time they'd need to make an entry would be in December. On the 31st, they'll debit cash for $562,907. They'll credit interest revenue equal to the original $3 million in the lease receivable minus the reduction in the lease receivable, also on June 30th, times the interest rate for a half a year. Again, you've seen that number, but $121,855, and then the credit to lease receivable is made for the difference in the two. That'll be the reduction in the lease receivable account. Getting on the credit side this time. There we go, $441,052. Now, number one, wanted to know the present value of the lease payments. We've taken care of that. Number two, what would show up on the balance sheet? Well, you'd have your lease receivable account balance. To begin with, it's $3 million. And then you had the June 30th payment. The reduction to lease receivable there was for the full amount of the payment because no time had passed off for interest to build up. And then we had the December 31st payment. Sorry, I can't type it. Can't type and talk at the same time. Okay, and that's going to be equal to just the principal reduction portion on the lease, or just the portion that deducted the decreased the balance in the lease receivable. So it's equal to a negative $441.52. Now, if we tally that up, we get lease receivable December 31, 2016. And we've seen that one before too, but that's the balance that that builders would show in the lease receivable account on December 31, 2016. And that's going to be on the balance sheet. And then on requirement 3, they want to know what would be the income statement effect. Well, it's a little different than the last time. We still have interest revenue for 2016. It's equal to our credit here to interest revenue, $21,855. But also we have some gross profit. We got sales revenue less cost of goods sold. So our sales revenue is equal to the 3 million. I just think this is much easier with the journal entries there to the left. You could certainly do this without those, but to me it just makes it much easier. Our cost of goods sold is 2.5 million. So the difference in the two is just our gross profit. Some books would call it gross margin. This book might even call it gross margin. Either one would be fine. Gross profit, gross margin, same thing. But your income statement effects here would be 500,000 of gross profit and interest revenue for 2016 for only 6 months, 121,855, and the balance in lease receivable would be $1,996,041 at the end of 2016. Okay, you guys, you've seen these the entries for an operating lease, which is what you knew going into the chapter. And then you've seen how to determine whether a lease should be classified as a capital lease and what the journal entries would look like on a capital lease on the books of the lessee and on the books of the lessor, and two different ways on the books of the lessor. If it's a direct financing lease where the only revenue the lessor is earning is interest revenue, or if it's set up as a sales type lease, so the lessor is earning not only interest revenue but some gross profit as well. Okay, that's it for Chapter 15. Please be in touch if you have questions on any of these. I'll be glad to go through them with you. And I hope you all have a great day.